Hello people, hope you're all doing good. So in this particular session, we'll be covering CA Final Financial Reporting ka MTP Series 1 for May 25 examination. So how's MTP? Oh, you're full happy pa. You also, me also. Why sir? 2 or maybe 3 questions are new. Rest everything cut, copy, paste from straight forward materials. Okay, only 2-3 questions if you do means you are also done with MTP. I am also done with my MTP. Okay, so in this particular session we'll be covering up those particular new questions which are added. All right, so only the new questions we'll be doing it. So good news for you. Case scenario number 1. I've given you the reference also. This is Ind AS 34 question number 12 in our class notes. Ditto, copy paste. Okay. Just that question was asked in a descriptive format. Same descriptive, they made it as an MCQ and asked the answer. All right. So this is the same ditto question. This second MCQ question is also repetitive. This is from Ind AS 115 and it is question number 67 from our class notes. Third MCQ is Ind AS 41 ka question number 8 in our class notes. Okay, so with this first case-based question fully covered, good news for me. Everything I say like this only now. Yeah. So second case study is based on Ind AS 2. R's here stands for repeat question. This is question number 25 from our class notes. And when I say question reference, this is our regular class note reference I've given, not the fast track. In the fast track also you will have these questions, but the question number may be slightly different. Instead of question number 25, maybe it may be question number 18 or 19 or whatever. All right. So I've given here regular batch ka referencing over here. But yes, rest assured you will find this in both regular batch as well as fast track notes. This particular question is same second case study ka part 2. This is Ind AS 109 ka question. It is question number 55 in our class notes. Ditto. Case number 3, Ind AS 103 ka question number 21. Cut, copy, paste, no change, ditto. Okay, all right. So this particular question number 14, I think this is based on Ind AS I think 115 question. This is all right, but it is there in analysis of financial statement of our chapter because you in a study there's a study material question. In study material, this was there in analysis of financial statements. So it is there as question number 7 in our class notes, and we have done this in MTP 1 May 24 also. We have done a separate video for MTP May 24. In that video also, this particular question is there. I think I've covered it there as well. I'm not sure. Yeah, maybe out of told, but anyway, in class though definitely it is covered. That is one. So got it. So all the 30 marks ka MCQ questions straight away they picked it from the materials and made from descriptive. They just converted into MCQ. That's all it is. Nothing, not even a single MCQ question which has been newly framed as such. Okay, sir. That is happy news for you. Next to first question. Okay, this is a good question. I'll keep this as an LDR. Theory question, but they framed good. 2-3 pages ka question they have found. This is Ind AS 111 ka question. Okay, so you have to add a lot of garam masala because this question came for around, I think, see if you just check the question, starts from first page, full second page they gave, full third page they gave, and then they are coming to the matter, explain. Okay, so when they say explain or analyze and all, you should go bonkers. Full garam masalas you need to add, provisions or pointers and all you need to add. So nothing, no calculation, just a simple question on Ind AS 111. Joint arrangement. Okay, but unfortunately they've asked for 14 marks. Doubtful that it can come for 14 marks and all in exam, because how much garam masala is also to add for 14 marks that too. There is no calculations to be done. So what is this question? We'll have to see. But before that, Ind AS 111. Do you remember what is Ind AS 111? Joint arrangement, right? So for it to be a joint arrangement and Ind AS 111 to be applicable, we look for joint control. Control should not be with one party. Control should be diversified. It should be jointly controlled, and unanimous decision is what we look for. That is a feature for your joint arrangements. And we know for accounting purpose, joint arrangements are of 2 types. Either it can be a joint operation, JO, or a joint venture, which is JV. How to identify whether it is a joint arrangement is a JO or a JV? We had some features. Remember our class notes, right? We had given all those pointers. Sir, if you don't open, if this joint venture business or if this joint arrangement business, if it is not done in the form of separate entity, if you don't open any new company, if you do the business in the existing name, then that is one of the features of JO. Okay, the business, you're not opened any new entity means that is a feature of JO. Then if it is a JO, the parties who have started this business, they'll have the share, direct share in the assets, liability, income and expense. Whatever that business is doing, that business ka respective share of assets, liability, income and expenses parties will claim. If they are able to claim such, if the parties are able to make such a claim, then that is a feature of a joint operation. Okay, that's what we've discussed. And for joint operation, we go for proportionate consolidation method. Proportionate consolidation method means each party, if this is a joint, if this business is floated by two parties, and if they have an equal share, each party will show their share of assets, liability, income and expense in their books. That's all. Other party share they will not show, only their share of assets, liability, income and expense they will record. Now those are your JO. What if it is JV? First of all, if you open this kind of business, if this joint arrangement ka business is done through a separate legal entity, a separate company or LLP if you have opened, right, then that is one of the features of JV. This is not condition, these are all features. One is that. And since you opened a new company, right, that new company only should be able to buy all their assets, settle all their liabilities, incur the expense, accrue the incomes. So if that company itself is buying the assets, incurring expense, settling liabilities and all, then that is a feature of JV. What about the parties? Parties are investors, right? Investors, if it is JV, means the parties in the contract, the parties in this JV business, they'll have a right over net assets of the company. If the joint venture shuts down, means equity shareholders will get a share in net assets. So if the parties in the contract get a share in net assets and net profits, then that is a feature of a JV. And if it is JV, we follow equity method, right? Ind AS 28 ka equity method we have learned. Same thing will be applicable for JV ka business. This is a theory. All this you need to write. Okay, that's all it is. It's a pure theoretical question. Okay, you need to identify whether it is JO or a JV and write this. How to identify? We'll see. That's your background is what I told you. Fine. All right, let's review this question now. A and B Limited are companies registered under Companies Act. Great. They both are Indian companies. Awesome. A Limited is Ind AS compliant entity and follows year ended March for reporting period. So A is following Ind AS. They have not commented on B. That means probably indirectly they're telling B is following accounting standards. A is following Ind AS and B is following accounting standards because they commented only on A. They told only A is following Ind AS. B ka they did not comment. So probably B Limited is following Ind AS. So we will give we will base our answer only from A Limited perspective because our syllabus is only Ind AS now. So since A only is following Ind AS, so we will give all the comments, so all the drama, mirchi masala, garam masala, we will add only from A Limited perspective. So let's see. On 1st April 2021, they entered into an agreement to jointly engage in a hospitality business. So they both have come together and to do some hospitality business. For this purpose, they formed a partnership firm. Go in the. Why? Sir, partnership firm is not a separate legal entity. Are partners and partnership firm different? No. If partnership firm has one asset, means that partner will have a right over that asset. If partnership firm is not able to settle liability, means partner ka personal assets can be utilized to settle that liability. Partners in partnership firm has unlimited liability. So if a firm has liability, means partner also automatically has that liability. So what's that means? The moment they say partnership firm, it's not a separate legal entity. So it is not a JV. So reading the first line, it looks like this joint arrangement. It is in the feature of JO, joint operation, because they did not open company. If it was LLP or a company, it was fine. Since same question was there. One question like this we have done in our Ind AS 111 also, if you remember. Since it's a partnership firm, it looks like a JV wala arrangement. Okay. Under relevant laws, the partners in the firm are not considered separate legal entities. They don't have to tell this. We know this. To regulate the operations of the firm, A and B have entered into a partnership with the following terms and conditions. So what comes? A and B shall be partners of the firm. Great. Consent of both the parties shall be required for taking decisions on any matter which can affect the returns of the business. So though they are partners, right? So one partner is not able to control the business. If any decision has to be taken, means both the party ka consent is required. So control is not with one party. There is a joint control over here. So since there is a joint control, this is a joint arrangement. So Ind AS 111 is applicable because there is a joint control over here. Except that it looks like this joint arrangement is in the feature of a JO till now. Yes. Okay. Right. Then see, the firm operates a three-storied hotel, 3 floors wala hotel, ground plus 3 floors probably they have. Ground floor will consist of some reception, lobby, restaurant and all. Both the parties shall jointly and equally own legal and beneficiary ownership of the ground floor, including all assets and related liability. So each person is having the share in assets and liability. Pakka JO. One, we do not. We opened a partnership firm, so it is not a separate legal entity, and each partner has a share in ground floor assets and liability. Means obviously this pakka became that this is a JO, joint operation. Okay. If it is joint operation, as I already told you, we'll have to follow proportionate consolidation method. Each venturer or each person or each investor will show their share of assets, liability, income and expense in their books. Okay. Here equal share. So ground floor ka whatever assets we have, we are anyway only A is following Ind AS. So A will show 50% of those ground floor ka assets and 50% of those ground floor ka liabilities in A Limited ka books because proportionate consolidation method. Okay, sir. All right. First floor has some Indian themed rooms on there. Some hotel, no? Some theme they have kept and made the rooms. A Limited shall have legal and beneficial ownership of first floor, including all assets. So first floor ka entire assets and liability belongs to A. 100% of assets and liability of first floor, they have agreed is that belong to A. Second floor is some Italian themed rooms in there for customers. So this B Limited will have. B Limited will have a legal ownership of that. Okay, net profit for the floor entirely belongs to B Limited. So assets, liability, profit of B Limited ka assets, liability, income and expenses of second floor ka rooms entirely belongs to B. That means A has 0% share in this. That's what they have agreed. Third floor ka assets, it comprises of banquet hall, the party hall basically. This both the parties will have jointly and equal ownership over this assets and liability. So 50-50 third floor. So ground floor ka and third floor ka assets, they are sharing in 50-50 ratio. First floor ka assets and liabilities, income and expense exclusively belongs to A. Second floor ka everything belongs to B. That's what they have agreed. This is initially when they entered into a partnership agreement, this was the drama. So pakka we got to know that the first year it is a JO. Alright. During the first year of operation, A many times doubted and objected to the manner in which guests were preferentially convinced by the reception desk to occupy Italian themed room of the second floor. So now fight started. Okay, they're fighting. What is it? So obviously it's a hotel business, no? So first floor of hotel rooms belongs to A. So if more customers stay in first floor means A will get more money. If more customers stay in second floor means more money B will get. So A Limited is objecting, saying we are indirectly influencing on the customers to take second floor room. We are probably giving that painting a nice picture. First floor, no, Indian theme room. What you'll go there, macha, you can stay in your house only. No. Second floor you should visit. That is Italian themed rooms. Go and stay there. Swarga bharate. Heaven is there. Yeah? Like that we are convincing and confusing the customers and making them go to book second floor room is what A is alleging. A is fighting over this. That all the customers is being pushed to second floor and not much customers are coming to first floor. So A profit is less is what A is fighting over. Okay. To avoid these repetitive disputes on 1st April 20x2. Stop. Sir, you made the arrangement on 1st April 20x1. So 1 year already happened. So first year, since each person had a share in assets, liability, income and expenses, and it was not a separate legal entity, it is for first year what it is, sir? It is a JO. So you need to write some drama. JA ka definition, JO versus JAO ka, I had given you one table. Remember that you need to write it. And then finally conclude that this is a JO and A Limited should show ground floor and third floor ka 50% of assets and liability A will show. First floor ka 100% of assets and liability A will record as per the agreement. This is what you'll write in comments. It is given. I've just given a quick snapshot what you need to call out. Okay. This is the first year. Now, because of this dispute, probably they did some changes in the second year that we will read now. To avoid these repetitive disputes, on 1st April 20x2, that is year 2, A Limited and B Limited converted partnership firm into company, Star Private Limited. Now, from partnership firm, it got converted into company. Okay, that means now it is look like JO. Oh, now it probably looks like a JV wala feature because new entity is formed. Okay, but hang on, just because you have formed a new entity, it will not become a JV, right? For it to be a JV, some indicators we look for. What is that? Usually new entity will be formed, that is company or LLP, and that company itself should buy all the assets. Company only should incur all the expenses and liability. That is the JV ka feature, right? Here we'll see. New company is formed. Okay. To regulate operations, A Limited and B Limited have entered into a shareholders agreement with the following terms and conditions. A and B shall transfer their individual rights regarding the respective floors of the hotel in favor of company. Currently, A owns 100% of first floor, B owns 100% of second floor and all. No, all that rights, they give it in favor of company. They're telling now all the assets and liabilities now belongs, in fact, here they told all the assets now belongs to the company. Great. So parties now don't have share in the assets. All the assets belongs to the company. Company shall assume all the liabilities A and B Limited in relation to hotel business. Now company has taken up all the liabilities on their head only. That means now it is good enough conclusion that it is a JV. First year it was a JO. Now it has become from JO. In the second year it has become JV. That's all you need to write. Okay, sir. In consideration of the transfer, A and B Limited in favor, A will receive equity shares of the company in equal proportion. Since they have transferred assets to the company, obviously, in company means A and B will have some equity shares. No, they've got some equity shares. Okay, that's what they've given. All that is remaining and all is goalie. Okay, so I think rest Chuma they've given some additional drama. Now from JO it has become what, sir? In the second year it has become JV. If it is a JV, we can't follow proportionate consolidation method. We have to follow equity method recommendation. That's what you need to write a goal. This is a major pointers, all right. So you need to little add garam masala and few other pointers you can write. Facts of the case, some 7-8 points you pick from the case itself and write it. First year this and all was there. Second year it happened like this. That's the reason from JO now it has become JV, like that. So 5-6 points you pick from the Ind AS 111 ka pointers. It is there. Remaining some 7-8 points you pick from the facts of the case and write it. Since it's a 14 marker, you need to write some pointers. Okay, your vocabulary little bit will be tested over here. Solution is given, but I quickly told that what is necessary. Okay, but you don't have to use fancy language and all. This is anyway there in our class notes. I've given you the pointers. Facts of the case you pick. They've only given so many points. No, bindas they've given. Like from this around 6-7 points you pick up, write it. That should be good enough in my view. Okay, sir. That's all. A pure theory question. Good question, just a little lengthy. That's all. Okay. All right, moving along. Question number 2A is practice question 2. Now, you remember I say I added some practice questions, right? So we have covered the same question we have covered in practice question number 2. Okay, in Ind AS 109 topic, you'll be able to ditto question. 2B is Ind AS 1 ka question number 7. Repeat. A foreign company. For foreign company, you don't have to, because Ind AS 1 works on net worth limit. No, if one company is applying Ind AS means their parent, their subsidiary company, their associates, their joint venture also have to apply Ind AS. But this particular rule is not applicable for co-subsidiary, and this rule is not applicable for foreign subsidiary. Same ditto question is there in our class notes. This is question number 7 in our class notes. 3A also is Ind AS 116 ka question number 52. Repeat, cut, paste, cut, copy, paste. Then 3B is question number 11 in Ind AS 21. Same name, same value, same everything. Ditto, repeat, no change. Good, sir. All MTP should be like this, sir. We'll be happy, sir. Yeah, yeah. I mean, how many MTPs ICA also will form, sir? Right? So usually like 2-3 questions they'll form new. The rest of the question they'll do cut, copy, paste only, no? Because now 2 attempts has become 3 attempts and all. So these sort of things will be a common occurrence, I feel, going forward. But yeah, 2-3 questions will be newly framed. Rest other than that, I think it will be mostly a previous repeat questions only. So 4A is Ind AS 102 ka. This is a good question, LDR question. We will solve this question. 4B is Ind AS 23 borrowing cost ka question number 7. Same question is there. That will not be doing it. Okay. This question number 4A, Ind AS 102 ka, we will do it. We'll see what we can do. In fact, this also is manageable. One pointer you need to especially emphasize and remember to take the data correctly. We'll see what is this. To reward its employees, company has launched a scheme on 1st April 20X1, probably the grant date, in which employees will be granted equity shares of the company at below market price subject to certain conditions. So we are giving equity shares to the employees. So it's an equity settle plan. Okay. All right, but we are not giving this options at free of cost shares. Probably there are some conditions. What are those? Let's review. As per the scheme, each employee has an option to buy 100 equity shares of the company at 30 rupees per share. Shares are not given to the employees at free of cost. Each employee can buy 100 shares, and for each share they have to pay 30 rupees. Market value maybe 80, 100 or whatever. We are issuing the shares at a lower than market value. Okay. If the employee does not leave the company for 3 years, every employee can buy how many shares? 100 shares at 30. But in order to be eligible to buy the shares, minimum they should work in the company for how many years? 3 years. That's your vesting period. Okay. So here vesting period is there for 3 years. Great. Okay. So you came up with the scheme on 1st April 20X1. 3 years if you add, that will get over on 31st March 20X4. Vesting, the shares will get vested on this particular date. Okay. Awesome. Fine. Once 3 years is completed and an employee, he or she can exercise option within 1 year, that is 31st March 20X4. Since the shares are not issued at free of cost, employees have to buy or pay the company 30 rupees. Extra 1 year time is given. If the employees want, they can buy all the shares on 31st March 20X4 also on that date itself, or they have 1 more year extra time to decide whether they want to buy it or not, because even they may have to arrange money and all. No? So extra time is given. That is irrelevant. As per Ind AS 102, employee benefit expenditure will always be booked over the vesting period, which is how many years? 3 years. Okay, fine. For equity settled plan, okay, this exercise becomes irrelevant, okay, because you always book the expense over vesting period, and for equity settled plan, there is no remeasurement concept. We take grand date ka fair value and do the accounting. However, if it's a cash settled plan, till the time of settlement, till the time actually employee buys the shares, you will have to take the fair value and you have to record it. We have done such questions, it is there, right? But this is a pure equity settled plan, so we don't have to worry about this much about exercise period. If they say this many employees bought the share, then we may have to pass a journal entry for that. We will see. The closing price of the share on the stock exchange on 1st April. 1st April is your grand date. The price of the share on the grand date is 62. So we don't want price of the share. We want fair value of the option. Fair value of the option means loss, right? These options or these shares will not be issued to employees at market price. They will be issued at below the market price. So company will suffer a loss. That only we call it as fair value of the option. In majority of our problem, fair value of the option will be directly given, right? So that fair value of the option as per Ind AS 102, we'll either find out using options pricing model or Black-Scholes model, right? Both are not there. It's an AFML topic, right? They used to give that. But here what they've given is a share price. We don't want this. Share price is not relevant to us, right? Correct? We want fair value of the option. So don't take this number, okay? Shares are not issued at 62. Got it? So don't do. Share price is 62, sir. Employee is buying the share as 30, sir. So loss is 32 per option, sir. No, there are other parameters also over here because the shares are not given immediately. It's given over a period of 3 years. So we have to use options pricing model or Black-Scholes model and get the fair value. It will be given to you. Check. If they don't give it, then maybe you can use that as a last resort. 62 minus 30, you can take it as 32, right? That's what we used to do in our CA inter days, if you remember. Okay, that is intrinsic value method we say. But Ind AS 102 allows only fair value method, right? So they will give you, check. Face value of each share is 10 rupees. Great. The company had appointed a registered valuer who derived the price of the option. Now they've given fair value of the option at what? 50 rupees using Black-Scholes model of option pricing. So now this is what they've given. So this is your fair value of the options using Black-Scholes model. How much? For 50 on the grand date. So we will take this 50. This is a loss per option company is suffering. We will use this for our accounting purpose. This 62 and all is irrelevant. Face value is relevant because the shares employees are buying at 30. No? So there is a premium element involved over here. So that becomes relevant here. That when the share employee buys the shares. Till now it's not. For the first 3 years, this 10 rupees has no impact. All we need is a grant date ka fair value of the option, which is given to be 50. So just that this particular data you should read properly, take the correct data. You should not do 62 minus 30. That's all. So as long as you take 50 and do the working over. That's all. That's all is a highlight of this question. Remaining and all normal, sir. Normal problem now. There are totally 300 employees eligible for the scheme. As of 31st March 20x2, we came up with the scheme on 1st April 20x1. Now we are on 31st March 20x2. So that means year 1 ending. Year 1 ending, mein, out of the 300, 10 employees have already left. And we know, sir, expense is booked based on what? Actual, no. We always book the expense. Ind AS 102 gives that liberty. What liberty? Company has to estimate how many shares will the employee buy. And how much ever shares the company feels employee will buy. On that, if you book the expense, it is sufficient. Okay. So all these are estimates based accounting and estimates can be revised. Okay. So now 300 is the number of employees to whom company gave this particular option. But how many employees have left the company? 10 have already left. And further 14 employees are expected to leave over the next 2 years. Now this is our data. So let's do our calculation. This is your normal. We put up, you remember before your journal entry, we put employee benefit expense ka working note. So this employee benefit expense you have to book over vesting period. How much is the vesting period here? 3 years. So 3 years column I've had. First, number of options expected to vest. Sir, how many options was given to how many employees? 300. In that, how many have already left? 10 actually left in first year. 14 are expected to leave another 2 years. So in this 300, 10 already left, 14 are expected to leave. So 300 minus 10 minus 14, if you do, 276 employees are expected to buy these shares. And each employee can buy how many shares? As per the question, each employee can buy 100 shares. So into 100 you do. So that means totally 27,600 shares are expected to vest using the company's estimate. That's the first thing. Yes. Okay, next, the fair value of the option. This, since it's an equity settled plan, we only take fair value on the grant date because for equity there is no remeasurement. So do you know? Yes, on the grant date using Black-Scholes model, the fair value of the option is 50. This will stay throughout the same 50-50. All right, same. Then the vesting period. Vesting period is how many years? 3 years. This will also be same throughout. There will be no change in this. Yes. Okay. Next, total expense to be recognized. Sir, the loss on one share, one option is 50. So totally 27,600 options are expected to vest. So 27,600 into 50, if you do, you'll get 13,80,000. So multiplying these two, you'll get 13,80,000. That is a total loss company is expecting to make. But will the total loss be booked in the first year? No, it will be booked over the vesting period. How many years? 3 years. So divided by 3 you do. We are in the first year, hence 1 by 3. So totally first year you'll book an expense of 4,60,000. Okay, sir. Since we are in the first year, expense recognized previously is 0. So current year we have to pass the journal entry for 4,60,000. Since it's an equity settled plan, what is the journal entry? Employee benefit expense account debit to share based payment reserve. Passed on. See, first year employee benefit expense to share based payment reserve 4,60,460. That's all. Okay. Now second year what drama happened? Check. During the X2 X3, X2 X3 is your year 2. A multinational company entered into the retail industry, which is hiring experienced workforce, and therefore high attrition is observed in the retail industry. Some MNC came, so they are offering probably good package. So many people are leaving our company and enjoying that MNC. That's what they're trying to say. That's okay. All that we don't need. We want how many employees are expected to stay. So in 300 employees, 10 employees actually left in the first year. Okay, 110 employees left the organization in the second year. Okay, huge, right? Because of that big MNC coming in, 110 employees left in the second year. 10 already left in the first year. 110 left in the second year. And further 54 employees are expected to leave in the third year. So how many employees are expected to stay? In 300, 10 gone in first year. Okay, 110 gone in the second year. Actually, 54 are more expected to leave in the third year. So 300 minus 10 minus 110 minus 54, if you do, number of employees expected to stay is 126. And each employee can buy how many shares? 100 shares. So into 100 if you do. So 12,600 shares are expected to vest. Okay, same. Okay, the loss on one share is 50. Fair value of the option, vesting period is still the same. So expense will be what? The loss on one option is 50. And we have 12,600 options. So if you multiply, you'll get the total loss to be 6,30,000. This has to be booked over the vesting period. Vesting period is 3 years. We are in the second year. So totally till second year, first year ka, second year ka, both expense should be recognized. Hence we write 2/3. So totally 2/3 of the expense you should have recognized. So if you do that, you'll get 4,20,000. By the end of second year, this much expense you should have already booked. Right? But what happened? First year already booked how much? 460. Sir, by the end of second year, totally you should have recognized 420. But first year only you have recognized 460. So second year, you have to book additional expense or you have to reverse. You have to reverse. 40,000 extra expense you have booked, which you need to reverse it. So to booking the expense, the entry is employee benefit expense to SBPR. So for reversing, it will be ulta, right? So it will be SBPR to employee benefit expense. And this employee benefit expense will be transferred to SPL. That's what they've done here. Okay. Transfer entry also they've done. Okay. This is the second year. Fine. Third year, what happened? Third year, only 160 employees remained out of 300. So they only given that finally at the end of third year, only 160 employees are there on our payroll. And each employee can buy how many shares? 100 shares. So totally 16,000 options are expected to vest by the end of third year. Okay. So actually vested, we don't know because 1 year extra time is also there. No. So at the end of third year, company is feeling that 16,000 shares will get purchased. So fair value of one loss on one option is how much? 50. On one share, if it is 50 means on 16,000 it will be 16,000 into 50. If you do, you will get totally 8 lakh, right? So since we are in the third year, the entire loss should have been recognized by the end of third year, which is 8 lakh, right? So by the end of third year, totally you should have recognized 8 lakh. But how much have you recognized till now? Till now you have recognized 420. How? So 460 you booked in first year, 40 you reversed in second year. So if you add these two also, you'll automatically get how much? 420. So out of 8 lakh, 4,20,000 expense you booked till now. So how much additional expense you need to book in the third year? These two got difference, which is 3,80,000. Pass the entry. What is that? Employee benefit expense account debit to SBPR 380. This is third year. And that employee benefit expense, you transfer it to SPL. This is the entry over the vesting period. If they don't give the exercise date information, our solution stops here. Let's see, have they given that? Okay. Usually they don't give exercise in majority of the problem. Exercise information when the employee bought and all, they don't give. Here have they given up? Actually, they have given. Check this. So, till now what, sir? By the end of vesting period, that is third year, we thought 160 employees stayed and we thought all of them will buy. But 1 year extra time is also given for them to decide, to arrange money and all, because exercise period is what? After vesting period, 1 more year extra time is given. What happened within 1 year? Only 150 employees exercised the option to purchase equity shares during 31st March 2025. So by the end of 4th year, though 160 employees remain, because these are all options. It's not a compulsion. If the employees wants, they can utilize this benefit and purchase the shares. Or if they want, they can reject this. So though we thought 160 will buy, finally only 150 of them purchase the shares. Since they've given this information, we need to pass the journal entry. What journal entry? Sir, are the shares given at free of cost? No. Shares are not issued at free of cost. Employees have to buy the shares. So what is the journal entry for purchasing the shares? Entry will be what, sir? Now, one by one, if you want, we can go through. What is that? First, employees will buy the shares. So entry will be what? Bank account debit. How many of them? Though we thought 160 will buy, but only 150 of them purchased. Okay, 150 employees purchased. Each employee can buy how many shares? 100 shares. And to buy one share, as per the question, how much money they need to pay? We can buy the share by paying the company 30 rupees. So bank account debit 150 into 100. Each employee can buy 100 shares, hence 100. 150 employees are there. If you multiply, these are the number of options or number of shares employee purchased. And this is the money that they are paying to the company, which is 4,50,000. Okay, sir. All right. Now, so far we have booked all the value in SBPR. How much balance is there in our SBPR? We can check our working note only. The balance in SBPR is 8 lakh. Is that required? So till the shares are issued, you will park the value amount in SBPR. On the day the shares actually are purchased, from SBPR, you will transfer it to equity share capital. So this 8 lakh SBPR is not required. SBPR has credit balance. How do you cancel it? Debit it. So SBPR account debit 8 lakh rupees. Okay, sir. Next to equity share capital. So equity share capital always at face value. Okay. So how many employees purchased? 150. Each of them can buy how many shares? 100. So basically 15,000 shares got purchased. Shares are always shown at face value, and they did give the face value of the shares. How much is that? The face value of each share is to be 10 rupees. So multiply by 10 you do. So means 1.5 lakh will be transferred to equity share capital. This is one. Okay, Saru? Alright. Now, what happened, sir? Sir, till now, if you just check our table, we have booked the expense for 160 employees. If you just check here at the end of third year, right? This is 160 is a number of employees. We thought 160 employees will buy the share. So expense was booked for 160 employees. But did 160 employees purchase the shares or only 150? 150, right? That means that 160 minus 150, that is how much? 10 employees. 10 employees did not buy the shares, but I have already booked the expense for it. Is that expense required now? No, it's not required. You can reverse it, right? So to booking the expense, what is the journal entry? Employee benefit expense to SBPR, right? Now for reversal, you simply do SBPR, you release it to retained earnings. That's all. If any options get lapsed, means you release it off to retained earnings directly over here. Okay. So how many? That you can get it. How many employees rejected this? 10 employees. And they were eligible to buy how many shares? 100, right? So far you booked the expense on how much? 1 second. For each employee, how much expense have you booked? Go back to your table. We have booked the expense using fair value of the option on the grant date. So the loss that we have booked in our accounts for one share is 50 rupees, right? For this 10 employees, this 50 ka loss per share is not required, which we are reversing. Okay, 50 is a loss per share. It is not required for 10 employees, and each employee can buy 100 shares. So this much loss, how much is that? 50 into 10 into 100. If you do, that is about 50,000. This much expense what we have booked is not required. Since vesting period is already over, this particular loss, whatever you have accounted, you will release it into retained earnings. So entry will be SBPR account debit to retained earnings. So to retained earnings 50,000. Okay, sir. Balance. Since there is a premium element involved over here, okay, the balancing figure you can transfer it to securities premium, or you can calculate also or get it as balancing figure, your choice. Calculate means how. So how many employees purchase the share? 150. Each of them can buy how many shares? 100. Right now, sir, the loss on one share which the company has accounted as how much? 50. And the employee are paying how much rupees for one share? 30 rupees, right? The loss that the company is suffering on one share is 50 rupees, for which we have done the employee benefit expense accounting over vesting period. That is okay. And how much money employees are paying to the company? 50. That means the value of one share is how much? 80 rupees. So the value of one share is considered to be 80, means the face value of the share is 10. So the premium element is 70 rupees per share. That's what you need to book. Okay. How many employees? 150 employees have purchased the share. Each of them can buy 100 shares. So the premium element is 70 per share. So 150 into 100 into 70, if you do, you'll get 10,50,000. Like that you can calculate. Okay. Or get it as simply as balancing figure, your choice. Okay. One you can calculate, and the last one you can get it as balancing figure, whichever. It's not necessary all the things you need to calculate. That's all is this question all about. Okay. Exercise 1 entry, I think we have done. These sort of questions are also there in our class notes. Okay. This is not entirely new to us, but you need to be careful about this particular grant date ka choosing. That's all. Don't take the share price and do the accounting. Whole thing will become chopper. everything will be done tomorrow. So you have to take this and do the accounting. As long as you are able to keep that in mind and pick up this data, rest everything, your format and things will take care of. So you don't have to worry about that. Okay. So that way, keeping that in mind, I've just made this question as an LDR. No, not that difficult. Just that little newly framed. Okay. Now question number 4B, as I told, Ind AS 23 ka question number 7. This is a ditto, no change. Okay. Same, similar. I mean, yeah. Ditto question is there. Next, what is next one? Oh, 1 second. Some system. Well, hello people. I think we were doing question number 4A. The screen kind of got timed out. So I just want to tell that, yeah, this is 4A is fully done. We've done. The remaining all questions are repetitive, sir. It's all there in our class notes. So 4B is question number 23, or rather it's Ind AS 23 ka question number 7 from our class notes. And yeah, I'm just giving you the reference. Question number 5A is MTP series 2 ka May 24 question. We have already covered MTP. That video is also available in YouTube. So it's that question, it's covered there. You can refer that. Question number 5B is from Ind AS 19 ka topic. It's question number 13 in our class notes. And this particular question is Ind AS 1 ka question 29 in our class notes. And then question number 6 is ethical duty of CA. It's question number 4 in our class notes. 6B is Ind AS 101 ka first time adoption ka question number 20 from our class notes. And the C part ka question is Ind AS 113 fair value measurement ka question number 3 from our class notes. Okay, so that was all about this particular MTP. Majorly all the questions are cut, copy, paste. 1 or 2 questions has been newly framed. That's all. Okay, thank you.